Good afternoon, everyone. This is Trey Smart here with another video to show you guys what you need to learn to become successful at trading. So we're going to go ahead and get right into the video. There are 5 things that I feel, or methods, technical analysis methods, that I feel that every trader needs to learn to become successful and consistent at trading the markets, whether it be stocks, Forex, cryptocurrencies. This is the 5 recommendations that I have that you need to go and research, whether it be on YouTube or online or reading books or going to someone to learn these methods. These are the methods that I found that are most effective and always active in the market, that you can always see and use to create potential profits and returns. So number 1, we have price action. Number 2, we have harmonics. Number 3 is divergence. Number 4 is Fibonacci tools. And number 5 is wave analysis. Now, I do have these ordered in the way that I feel they are most important. From beginning, number 1 being least important, to the last being wave analysis, which I feel will be most important. They also are in order pretty clear. Some of them are around the same, but in difficulty and the amount of time it takes to learn, I feel that is the same order that they are in, that I've listed them in as well. And we'll go through them in those phases. So I'll go ahead and start off with price action. Now, price action is the relationship to how price reacts to support and resistance, and how price reacts to trend lines and counter trend lines as well. So when you study these candle formations at these potential reversal zones, you can find trading opportunities using price action. So I'm going to go ahead and show you guys an example of using price action right here on Euro USD. So I'm going to go ahead and use my trend line tool. So I'll apply this from the high of Euro USD. I'm going to bring it across. I'm going to connect it to the lower high. So when using price action, what you're going to do is look at 2 things. You're going to look at how price reacts to the trend line, and you're also going to watch how price reacts to support and resistance lines. So we're going to go ahead and add a support and resistance line as well. I'm going to bring these 2 things together. Now, I'm not going to go into an in-depth explanation about price action. However, I will be showing you guys, a very fundamental way of looking at these different types of technical analysis, so that you can begin your research, or reach out to me or someone else, or search the internet for more information on how to use these strategies. So what we're looking at here when we look at price action is that we see that price has started this trend. Now, a real trend is 3 trend line touches. So we count the first one where it begins is 1. We count the second one where it is 2. Now, price comes to this point. However, it does not reject and continue with the trend. What it does is that price breaks the trend. Now, many times when price breaks a trend line, what they'll do is they'll give what we call price action. Even rejecting from the trend is called price action as well. However, in this case, price breaks and it comes back and it retests the trend line. Now, many times this price action can be very easy to spot, or price will actually come and touch the trend line and continue with the trend. Or there are times when it just will retest and then it will continue with the new short-term or even long-term trend that it will be making. Another form of price action is here. Price once broke this area, and this is where it came back to retest. What we can look forward to in the future, which took a few weeks to make, is that price came and it made higher highs and lower lows and higher lows, and then it came back to this trend line, or what I should call is a support line. So when it came back to the support line, it could have done two things. What price could have done is price could have broke it and retested it and continued down. But instead, price came and it rejected. So with using these two moves together, we can actually see that price rejected from a support. Now once price rejects from support, we can actually look for opportunity to buy after it also breaks the short-term bearish trend. And this is a good example of a price action trade that one could have taken to make a potential profit. We see we get a rejection from a previous support area, and then we also get a break and a rejection from a recent trend line. Now for some of these moves, like I said, a true trend line would be 3 touches and it continues. However, I'll call them reference lines for today when in regards to price action, because you use a lot of the trend line tools, but you're not necessarily always making trend lines when you're using the tool. So that is an example of price action. So the next form of technical analysis that we'll be going through will be harmonics. So I'm going to go ahead and go to a different chart to show you guys a harmonic example. So harmonics is the combination of geometric and Fibonacci numbers, or geometric shapes and Fibonacci numbers. This method applies the concept that patterns complete and repeat themselves, therefore allowing you to make predictions for where price will go in the future. Now I have a really good example of a harmonic that I drew out on USD JPY. This is probably the largest harmonic that I've drawn, as well as the most profitable so far harmonic that I've drawn since I've been trading. Actually one of my favorite to reference. Now there are many different harmonics that have been discovered or created by different traders in the past, but there are many that are the more mainstream harmonics. Some may be familiar with some of them. So you have like the butterfly or the crab or shark, and then you have others like the Gartley, or even like the 5-0 pattern or 3 dives. There's many, and you can look them all up on the internet, and I'll probably drop a link to some of the PDFs to show you guys some examples in the link in the description. So let's go ahead and draw a harmonic. Now a harmonic typically uses about 5 points on the harmonic for you to draw this geometric pattern that has Fibonacci relationships between them. Now all Fibonacci relationships derive from the 61.8. So whether you're squaring it or looking for the square root or dividing it by 2, whatever the case may be, they all derive from the 61.8. So let's go ahead and draw a harmonic that I drew out in the past, and let's see how successful it was. So see, I believe that I drew it from here. So for this harmonic, what we're looking for is the 38.2 here. So I think I drew it from the wrong high there already. We look for around the 88.6 for C, and for this harmonic we will be looking for the 88.6 as well for the D point. So now with harmonics, the market clearly is not always going to move perfectly, but what we get, now I'll spot it out for you. So this here is what you would call a bearish crab. For a bearish crab, you would be looking for the 38.2 here. So this is a 37.6. This is very close. Here we will be looking for the 88.6, slightly below that point here, and then for D, we're looking for the 88.6. It's just 0.01 points off. And what we got here on this harmonic, which I did send out on my trading view as well as to my trading group, is that we got a very huge pattern that played out from this point. Price came and it gave you a double top, and it's still falling to this day, as it will potentially be returning back to the upside pretty soon. However, this is what I expected. My take profit for this trade was the first take profit back to the B zone, which was actually hit here a couple months later. And these are harmonics can be used for very long-term trades as opposed to price action cannot necessarily show you a long-term move, but it can give you a probability of a reaction at a certain area. So this is one good example of harmonics and how they can be used to predict the market based on these geometric patterns, which is basically two triangles, and they are basically connected by different points where they have a Fibonacci relationship. And we'll get more into Fibonacci later because that is one of the forms of technical analysis that I'll be going over as well. Alright, so for our next example that we'll be using is divergence. Now, divergence is basically a phenomenon that's observed when looking at an indicator versus the price of the market. And when you look at those two, divergence is the phenomenon of seeing something different happen on an indicator and something different happen on the price. So I can give an example. I'll pull up a basic indicator to see if we can spot out some divergence in the market. I'll give you guys a quick example. So let's see. This is one of the most basic indicators that traders use. You can even find the RSI on babypips.com. So this should be a pretty easy example of divergence that I can spot. So there goes one right there. So let's go ahead and pull this up and give you all a good example of when divergence is at play. So if we compare the price of USD JPY from April 14th over to let's see, what is it, September 8th, and then if we look at those same dates on the indicator here and compare it to the same date on the indicator here, we can see that we are getting completely two different types of moves in the market. Now this gives us a great opportunity for a trade if you're paying close attention. I've studied divergence and can spot it out pretty easy. So here the market is making a lower well, a higher low, and this point is making a lower low, as opposed to the indicator is making a lower low, and this point here on the indicator is making a higher low. So we're getting two different things, and this is what is called divergence. Now if you're a pretty good trader and you know the correct market patterns, the correct price action, the correct Fibonacci's, you would be able to take this setup in the market on the daily and you would have made pretty substantial profit. This is enough pips to definitely gain 50 to 100% return on your account in just a couple of weeks with good risk management at that. Another confluence with this is if you add all 5 of these different strategies I'm putting together, your trade becomes to be perfect, because this point actually hit the same take profit, which was a potential reversal zone for the harmonic that I was looking at. So had it hit that, and I also saw that there was divergence when it did, this would be a good area to take a trade, which I did buy from this zone as well, as well as selling from the zone of the harmonic. There's always multiple different reasons. And one could also argue that we have a harmonic here that completes as well. There's harmonics all over the market. But this is an example of divergence, and there are many more that we can see on the charts as well. I can actually see another one that I can bring up really quickly. Now I wasn't thinking about this one, but this is one that we just traded this week. So from here to here and from here to here, we have something different happen on the market. Now I'll be able to explain this pattern and what's going on in a future part when I talk about wave analysis. But here we have a lower high and we have a higher high. But at this part, we have a higher high, and at this level, we have a lower high. So this area here and this area here represent each other, but we clearly have divergence for an opposite move. When you get divergence like this is a trading opportunity for a sell. And me and my group, we definitely, not only for the purposes of divergence, but for many purposes, we saw the sell for this level. There's also price action at this level as well that can be used. It's actually this level just has so much going for it. And this is the beauty of trading. And when you learn multiple different ways of trading, you can spot multiple different trade setups. So just with price action, clearly this point was a low, and just like I explained earlier, price can always choose to reject a previous low, or price can choose to break it and retest that previous low. And that's what it did in this case, is that price has now broken it, it's retested it, and now it's continuing down. So multiple reasons to take the same trade. That's called confluence, and that's what you want. And that's why I'm teaching a bit of each of these methods, so that you guys can go out and do your research and discover different methods. And the more confluence you have for a trade, more than likely the better the trade is going to turn out, the more long term it will be. Alright, so the next tool that we're going to use and go over is called the Fibonacci tools. Now there are two main tools that I'm going to reference, but there are probably dozens of tools out there that I don't know about, but they aren't as important as these main two. The first Fibonacci tool is the Fibonacci retracement tool. Now the Fibonacci tools are basically ratios, like I mentioned before, that include and are derived from the 61.8. They use these to measure the market's retracements and the market's expansions to predict where the market will come and where the market will go. So how can we use these retracement tools in the actual market? So the most common tool, the most common ratio on the Fibonacci tool is the 61.8. So I'll go ahead and drag the tool out, and we can look at some of the different ratios on the tool. So this here is the Fibonacci retracement tool. The Fibonacci retracement tool is applied from one high or low, or from one low to one high, to see how much the market will retrace up to 100%, and sometimes even further. So let's take a look. Let's assume that price is coming from a high point and it's made it down. Let's get this tool. There we go. Let's say that price is coming from a high point and it's made it down to this point. I'm just drawing it in there, but this is how the tool would be set. It would be set as 100%, which is 1 at the high of that point, and if the market is moving in this direction, from left to right is how the market is moving, 0 would be at the bottom. So this is 0% retracement. So how the Fibonacci retracement tool is used is that we are predicting where would it be possible for the market to retrace to. Will it retrace to the 23.6 or the 23.6? Would it retrace to the 38.2, or would it retrace to the most famous 61.8? Many times you'll get the 61.8 or the 78.6 or the 80.6, and sometimes even the 50. There are different numbers that it can retrace to, and they're all in different situations. So let's say if you're in a harmonic, for example, like here, overall this level was an 88.6 retracement of a previous down move that came from the past. And likewise for any other trade, every move is a retracement of some other move. But in the right context, you can predict which level it may come to, and if you get the correct reaction or the correct pattern in that area, you can confirm that move and actually make money because it did what you expected. Now fibs can be used by themselves. However, they work best when they're applied to a different strategy. So if you apply Fibonacci to price action, if you apply and make sure that you're using Fibonacci with harmonics as it should be, or if you have divergence along with a Fibonacci level that is expected. Or even wave analysis that I'll speak more about next. If you have the correct Fibonacci ratios that goes with wave analysis, then the better that trade will be. So Fibonacci is a powerful tool, not necessarily used by itself, but in the right context with other tools, it's a really great tool to use. So last, what we're going to talk about now is wave analysis. Now, wave analysis is the study of impulses and corrections in the market that can be identified in sets and patterns of 3 and 5 waves moves with higher and lower time frame fractals. So what you'll get with wave analysis is that there's the same patterns, just like harmonics, that repeat themselves on different time frames, whether it be the weekly or the hourly or the 15-minute, the 1 minute. These same patterns repeat themselves over and over in either 3-wave sequences or 5-wave sequences. And they can be measured, they can be identified and categorized, and they're all throughout the market. Right now, just even looking at this chart for USD JPY, there are dozens of wave patterns that can be identified and easily traded. So we can try to spot out a few. Now, the most famous wave patterns that you can expect, and these are corrective wave patterns, are flats and zigzags. Now, the market does a number of these patterns every day, in every market, whether it be stocks, crypto, or Forex. The wave patterns are defined by 3-wave moves, typically resulting after an impulse. They do contain, like as a fractal, which means that there's one pattern within another pattern within another pattern, which makes it pretty complicated sometimes, but also it makes it a lot easier to identify when a wave pattern is around. So what we're going to do is consider that this move down is an impulse in USD JPY. So what happens is the market will go into a pattern that it makes. So you get one wave up, one wave down, and another wave up. Now the waves work in a certain type of fashion. That one wave up is an impulsive move. The second wave would be a corrective move. The third wave would be an impulse move. And after that, you would now get the higher time frame impulse that comes after the first impulse. So you have impulse, correction, impulse. What's interesting is that this move is also impulse, correction, impulse. And even this entire structure creates even a bigger structure of impulse, correction, impulse that leads to another impulse, much like how this pattern has an impulse, correction, impulse, which leads to a bigger impulse. Now these patterns repeat themselves in so many forms and fashion throughout the market. Even previously, what we were just looking at on USD JPY is a pretty specific flat pattern. This pattern here on USD JPY is what you would call a running flat pattern. It's pretty different, and it has different things that you can categorize it by that makes it different. So one is that this pattern makes a high, and it makes a lower low, and then it makes a lower high before it continues with the structure. And drawing it geometrically would look like this, as opposed to this pattern here does more or less the opposite. It makes a high, it makes a higher low, and then it makes a higher high. They much are the opposite. However, they still fall under the same category as a flat pattern, which is a simple 3-wave pattern that is meant to continue the trend. And they come after impulses. So I'm not going to go and spend too much time on wave theory, because we could go on all day. And I'll go ahead and get ready to conclude the video from here. But these are the top 5 forms of technical analysis that I recommend every trader to look into, learn, and master, because once you master them all, you'll practically always know when the best moves are about to take place in the market. I know many traders are excited about getting 20, 30, 50 pips a day. However, when you learn these strategies together, you can catch hundreds and thousands, within a week. And it may sound, pretty extra, but it's the reality of the circumstances, that you'll know when it's a good time and a bad time not to trade the market, because you'll know what phases it is in. You'll know when the trade is not ready or as opposed to really ready. You'll know when to hold, when to cut your losses. The more knowledge, the better. So please feel free to comment. Let me know if you like the video, if you want to learn more about a certain form of technical analysis. If you have something that I didn't mention and you want to learn about it, what I feel about it, please let me know in the comments below and reach out to me. I will drop my email or any contact information for anybody that wants to. Feel free and contact me. So thank you. Peace out. This is Trade Smart. Bye.